Welcome back, and we are coming back to earnings analysis. Bank of Baroda posted a good set of numbers. You can't complain. The asset quality has improved considerably, and the advances and deposits growth at about nearly 12% each is fairly decent compared to most other banks, especially public sector banks. The problem for the market is really the NIMs. The net interest margin is not climbing above the 3% mark for the bank as a whole. And that's pulling down the profit growth as well, as you will see in just a minute. Let's invite the management. We have with us Mr. Debadatta Chand, the Managing Director and CEO of Bank of Baroda. Good morning, Mr. Chand. Thank you very much for spending time for us. Appreciate it. For starters, if you can tell us the NIM problem. I mean, I'm starting with the negative because that's the only thing investors are worried about. They're happy with everything else. The net interest margin, is it large? Is it that your cost of funds has gone up? Is it showing any signs of plateauing?
So thanks, Latha, for inviting me. And the fact of the matter is that the bank is very consistent in terms of whether it is a top line, bottom line, asset quality. The profitability has been very consistent for the last 8 quarters, so as the ROA. As far as the margin is concerned, let us be very clear that there is an underlying market where there is a cost of deposit, it's still elevated, right? A scenario where the cost of deposit is elevated, we had a guidance earlier from 3.10 to 3.20. But in between, there was an accounting change in terms of the penal interest and penal charges also that impacted the NIM by almost 5 to 6 bps. Having said so, if you look at the 9 months NIM, it is at 3.08, which is marginally lower than the guidance we had given of 3.10. So looking at a Q3, something slightly lower at 3, but we are hopeful that for the full year, we'll be maintaining the margin at 3 to 3.10. It's quite natural in a market wherein if there is a elevated cost of fund, the deposit market is tight, the margin would slightly get squeezed. But a scenario where the margin is squeezed, again, we're able to optimize the ROA. The net interest income has been very strong. So it's a combination of multiple factors. We have been very consistent in terms of the growth profit. The 9 months profit has been almost up by 12.6%. The top line is growing at almost 12%. So these are very consistent, stable. That is what sustainability is key, important part of the profitability, not the margin per se for a particular quarter.
Okay. No, I take your point that so much depends also on how you deploy funds, and you have had a very big retail deployment, which must have given you a higher yield, higher return on the funds deployed. Higher retail gives the fears of unsecured debt. What is the percentage? And are you noticing any signs of trouble? What is the NPA in the unsecured credit itself?
So that's a very fair point. If you look at my retail growth, we are consistent almost 20% for last many quarters, 8, 9, 10 quarters now. Having said so, we have also said earlier that the focus continue to be on the secured part of the retail. The loan in the mortgage loan, the housing is growing almost at 17%. The auto is growing at almost 17%. So we are not focusing on secured personal as a growth lever in terms of the retail loan. The book as on today is almost 30,000 crore. And the GNP on the unsecured personal loan is almost like 3%. And if I talk about the retail GNP, it's something around 1.6%. So the levels are much lower in terms of the overall slippage. As saying so, we said earlier, actually, rather we're the only, the bank to say in June 2023 that we're going to moderate on the unsecured personal loan. At that time, the growth almost used to be 80 to 100%, but now the growth is almost 24%. And in between, we have strengthened a lot of underwriting standard, quality, the model and everything. So we're quite comfortable growing at 25-30%. And the book is not giving any kind of elevated slippage for us to slightly be concerned about that. We're quite comfortable with the retail growth of 20%, and primarily the focus continue to be on the mortgage side rather than the unsecured personal.
Okay. Can you give us some guidance on what's the loan growth expected overall, retail?
See, going forward, we said that full year we are targeting a loan growth of 11 to 13%. Rather, we'll try to operate at the upper band. That means I'm talking about 13%. Within that, the retail continue to be at 20%. The agri MSME would grow at 14%. And the corporate would grow at 10% for the full year. So maybe, the total can be around 13 or slightly marginally higher than 13% for the full year.
Okay. You'll be able to bring down your loan deposit ratio in that case? Will advances, what I mean is, will deposits also grow as good?
So that is what actually we had given a guidance last time. Rather, we revised the guidance 1% lower last quarter, and we said the deposit growth would be 9 to 11%, right? And the current quarter growth is 11.78%. So saying so, the guidance on the deposit continued to be 9 to 11%. So we operate at the upper band, let's say 11% deposit growth and 13% advance growth. My LDR, the CD ratio, continued to be at 84.
Okay.
So